Hi everybody, Lance Browning, Income Solutions Wealth Management in Tyler. It's July and it's time again for our halftime report. So we do one of these every year and we want to kind of look midway through the year at what all has transpired during the year and what we think is going to happen going forward. Having said that, this year, because we've had so much going on with inflation, for example, we will talk a little bit longer this year than we normally do. So starting off, I wanted to start with just showing you the GDP report. GDP stands for Gross Domestic Product. It is the bottom line report card on the U.S. economy. That will show whether the economy is growing or contracting. So first quarter GDP for 2021 just came in at 6.4% growth. That was well ahead of estimates. That's a big, big number. Just keep in mind that we're looking at year-over-year numbers from the COVID pandemic last year. We're predicting even bigger numbers for second quarter, and those should be coming out very, very soon. In between report cards, we can look at different indicators, different things within the economy that are going on that will tell us the direction of the economy, yes, and also may tell us if there are any storm clouds on the horizon. One such indicator we can use are pickup truck sales. Interestingly enough, when the economy is doing well or is on its way into an expansion, people and companies buy more pickup trucks. When the economy is contracting or we may be heading into a recession, you'll see that people don't buy as many pickup trucks. The blue line here that you're seeing are pickup truck sales in the U.S. These gray bars are actually recessions, and you'll see that prior to a recession, often pickup truck sales will start to decline. That's a really good indicator that we can use. I have a long-term client that is a forklift dealer, sells forklifts. And he is sort of my leading economic indicator. When I want to know what's going on with the economy, I don't cut on the news. I call him and I ask him, hey, how's business going? What are you looking at for the rest of the year? Very, very, very helpful, good indicator. Another indicator that we use that I really, really like is the CAB index, Chemical Activity Barometer Index. So basically, industrialized economies like the U.S., when they are growing, consume chemicals. The CAB index is a composite index which comprises indicators drawn from a range of chemicals and sectors, including chlorine and other alkalis, pigments, plastic resins, and other selected basic industrial chemicals. And you'll see here, so the blue line is actually the CAB index. Again, these gray bars are your recessions. The orange line is a moving average. So we want everything above the orange line. We want the blue line above the orange line. So when the CAB index is up, that's generally a good indicator that the economy is growing and expanding. When that CAB indicator declines, particularly when it goes below the orange line or its moving average, that's a really good warning shot that a recession may be imminent. According to the American Chemistry Council, the CAB index has historically led recessions by 2 to 14 months with an average lead of about 8 months. So this is a really, really good early warning sign that we can use. And right now that CAB index is really, really going strong. We can look at, and we'll talk about consumers here in a second, but let's look at the other side of the economy, the manufacturing or the producer side of the economy. This has been pretty strong, and you've had a big recovery since the pandemic last year, but still experiencing big time supply chain issues. COVID, Snowmageddon, container ships run aground, cyber attacks, China, all these things are contributing to some supply chain issues. The manufacturing side of our economy, while improving, cannot improve as much as it needs to because they're having a hard time with labor and raw materials. There continues to be a pretty wide gulf between the production and the consumption sides of the economy. More on that in just a second. So the U.S. consumer is roughly 2/3 of the U.S. economy. All right. The orange line again is the Consumer Confidence Index. So when people feel good, they tend to buy goods and services. That helps grow the economy. When people are scared or concerned or they don't feel very good, that's generally a good indicator that the economy is not going to be doing well. Again, you can see when the consumer confidence index is rising, economy's growing. You see that in the orange line. The gray bars, again, are recessions, and you see that prior to a recession, consumer confidence drops. Now, we're improving dramatically. In fact, this index was at 127 points back in June. That's really good, but we're nowhere near where we were pre-COVID last year. Consumers are still worried about things like inflation. Okay, and we're going to talk more about that in a second. But the irony with inflation is that inflation can be a very self-fulfilling prophecy. I'll give you an example last year. So for whatever reason last year, when the fear and the panic began to spread about the COVID virus, consumers in their mind believed that we are going to have, for whatever reason, I don't know, we're going to have a shortage of toilet paper. Okay? So what did consumers do? In anticipation of a shortage of toilet paper, they went out and they bought pallets and pallets and pallets of toilet paper. They bought a 20-year supply of toilet paper in one stop. Well, what happened? That hoarding, if you will, caused a shortage of toilet paper. And I think you're seeing some of that in the economy right now. So let's talk about the 1,200-pound gorilla on steroids in the room, and that's going to be inflation. The theme of our halftime report this year is going to be inflation versus inflation. Last year was Fed versus COVID. By the way, the Fed won. Fed versus COVID. This year it's going to be inflation versus inflation. The question being, how temporary, how permanent is inflation going to be? There's no question that it's here, but how big of a problem and how long of a problem is that going to be? So let's harken back to our junior high economics class that we all slept through. And back then we were given a definition of inflation, and I want to use that definition for purposes of our discussion here. Inflation can be defined as too many dollars chasing too few goods. Too many dollars chasing too few goods. We measure inflation by something called the CPI, or Consumer Price Index. Consumer Price Index. So going back to May of this year, for May, the Consumer Price Index rose a little over 5%. That was the biggest number since 2008. To put that in perspective, you go to the store, you buy an item, it's $1. You turn around, you go back to the same store, you buy that same item a year later, and it's $1.05. That's the power of inflation. Not only have consumer prices been rising, and we'll talk more about this in a second, but producer prices for manufacturers have risen dramatically as well. Highest since the early 1980s. Everybody remember Paul Volcker. Okay? Now, CPI, or inflation, will tell us how fast prices are rising or falling. Now, our friends at the Federal Reserve tell us that inflation is a quote-unquote transitory problem, that it will be temporary, that it's only here for a short season. We'll see. Speaking of too many dollars, let's take a look at the size and growth of the U.S. debt market. Okay, so governments, corporations, individuals all like to spend money. So they like to spend money, then they like to turn around and borrow money so that they can spend some more money, right? Well, let's talk about how we got here on inflation. So you've seen since 2007, since prior to the financial crisis in 2008, you see here in the gray box that U.S. Treasury bonds, government debt, has risen 279%. And a significant chunk of that has been just financial and monetary stimulus response to COVID last year. But you see, U.S. Treasury bonds have grown, debt has grown by 279%, mortgages by 82%, high yield or junk bonds by 109%, investment grade corporate debt 235%. So you've seen this massive, massive increase in the debt market. We're going to look at the Fed's balance sheet here in a second, but too many dollars, too many dollars. Looking at interest rates here for a second, this is the U.S. federal funds target rate. In other words, this is the rate that banks charge one another to borrow money. Okay, and this is a rate that the Fed controls pretty much directly. You'll notice that it's currently at 0.25%, very, very near zero. Now, these low rates are likely helping to drive up the debt levels that we saw on the previous slide. This can be stimulative to the economy as it encourages borrowing, but can also lead to excess borrowing and inflation. You have seen a meteoric rise in central bank balance sheets since the October 2008, since the 2008 financial crisis. But you've seen even more substantial growth since the onset of COVID last year. The gray line, all three of these are central bank balance sheets. In other words, how many assets central banks like the U.S. Federal Reserve, the Fed, own currently. Okay, so since or as of right now, and most of this again has been since the 2008 financial crisis, as of right now, the U.S. Federal Reserve has $7.72 trillion worth of assets. That's mostly going to be U.S. Treasury bonds and mortgage-backed securities on its balance sheet. Almost half of that total, $3.6 trillion, has been added since the beginning of 2020 in response to COVID. All right, so stay with me. You've seen this big rise in debt. You've also seen this big rise in balance sheets, what the government central banks own worth of that debt. So what's happening? The U.S. Federal Reserve, our Fed, currently purchases about $120 billion a month worth of debt, primarily Treasury bonds and mortgage-backed securities. This money then flows back into the economy. So the government, the Treasury, will issue bonds, will issue debt. They will issue mortgage-backed securities. The Fed then turns around, prints money, they call this quantitative easing, prints money, buys that bond back, buys those treasuries, buys those mortgage-backed securities, and holds them on its balance sheet. Too many dollars. The M2 money supply, which is cash and cash equivalents in the economy, is up about 30% just from a year ago. Too many dollars. With large debt and deficits, with all the stimulus spending, and with dramatically increased money supply, too many dollars, it shouldn't be a surprise that the U.S. dollar has decreased in value over the last year or so. You see that on the chart here. So the U.S. dollar index is currently trading at about 93.23, or call it 93 cents on the dollar. Okay, I will note that this is still above the 30-year average for the U.S. dollar index. Now, the thing to keep in mind, though, and be careful here, the dollar does not trade individually like a stock does. Currencies trade in relation to other currencies. So when you see the dollar, the U.S. dollar quoted, it's dollar to the euro, dollar to the yen, dollar to the yuan, dollar to the peso, or whatever other currency. Now, I'm not saying that we don't have problems in this country, and I'm not saying that we don't have problems financially in this country. We certainly do, and we've been showing you that. But the U.S. dollar is not going to be worthless. And no, gold is not a currency, but find another currency that you would rather own than the U.S. dollar. Interesting. So, have you priced lumber recently? Have you filled up your car recently? Okay. Would it surprise you to know that lumber prices have increased almost 300% since April of 2020? Anything that is built or manufactured requires raw materials. That's where commodities come in. Commodity prices have risen very sharply recently. This would sort of fall under the too few goods part of our inflation definition. Too many dollars chasing too few goods. The commodity conundrum and all the problems we've got there with the supply chain are going to fall under the too few goods part. Demand has increased dramatically as the U.S. and global economies reopen and recover from the COVID pandemic last year. There was a ton of pent-up demand that manufacturers and those supply chains either couldn't anticipate or couldn't meet up with. So the supply of goods has not been able to keep up with this rising demand in the near term. This is causing these prices to go up. That's inflation. Car lots can't get new cars because there's a microchip shortage. I was driving down the loop here in Tyler the other day, and I drove past Classic Toyota. That parking lot is a ghost town. They can't get cars. So, no new cars being available has driven up the prices of used cars. This is very, very inflationary. In fact, 1/3 of the consumer price index, the inflation readings that we've been getting, consist of used car prices increasing. So used cars are contributing dramatically to inflation. Now, having said all that, we do believe that this part, this too few goods part of the inflation conundrum, is transitory. Supply will eventually catch up to demand, helping ease prices. This will ease some, but not all the inflationary pressures that are driving prices up. Love this chart. So speaking of supply and demand and the dollar, what you see here, the dark blue mountain, are commodity prices. That's a commodity index. The light green line is the US dollar. So commodity prices and the dollar are typically inverse related. Okay? Imagine two kids on a seesaw. One end goes up, one end goes down. When the US dollar index is down, commodity prices, hence inflation, tend to go up. And that's what you've seen recently. When the dollar goes up, commodity prices typically go down. But this is a big part of what's driving, in addition to supply and demand, this dollar relating to currencies is part of what's driving up prices. Welcome to the business cycle. We are here. We're in phase 3, thank goodness, of what is known as expansion, okay? And you've seen some pretty significant rises in asset prices. You've seen the stock market move up significantly from March of 2020, last year, during kind of the height of the COVID pandemic and the shutdowns. You've seen from there to March of this year, you've seen the S&P 500, the stock market, rise about 56%. Been really strong, and it's gone up even more since then. But look at what you've seen with commodity prices, up 151%. Okay? All right. No wonder commodities are contributing to inflation. Go into a restaurant or a retail store, and gosh, most businesses, what do you see? Well, you see help wanted, now hiring signs. There's a labor shortage right now, big time in this country. Employers have positions, about 9.2 million to be exact, jobs, positions that they can't fill. The U.S. economy still needs to add about 8 million jobs just to get us back to pre-COVID employment levels. Employers are having to pay higher wages to lure employees back into the workforce. Some of this is due to unemployment benefits, but this is inflationary, and this may not be transitory. I want to stress that. These businesses will have to raise their prices even more to compensate for higher labor costs. This part of the inflation equation may be with us for a while, unfortunately. Unemployment currently sits in this country about 5.8%. We talked just a second ago about the Fed balance sheet and the growth in the Fed's balance sheet. So what effect do the Fed's policies have on the stock market? Well, look no further. What you see here, the blue line, is the Fed's balance sheet. And you see that big increase post-2020 to compensate and address COVID and the pandemic, okay? Look what's happened to the stock market. Do you see a pattern forming here? I mean, the stock market has pretty much moved in lockstep with the Fed's balance sheet. Now, I do not have a chart that shows the Fed's balance sheet in relation to real estate, but if we did, I think you would see it would look exactly just like the stock market. The very same things that are driving the stock market have been driving the real estate market. Predominantly low interest rates and the activities of the Fed. As the stock market has rallied to new highs, new concerns have arisen. We start evaluating and looking at where the stock market is from a valuation standpoint. Is the stock market expensive? Is it overvalued? Has it gotten ahead of itself? One thing we can use is called the Shiller price index or price to earnings ratio, Shiller PE. In other words, how expensive is the stock market? Going back over the years, you'll see right now the price to earnings ratio of the stock market is very high right now. It's not as high as it was during the tech bubble in the late 90s, early 2000s, but it's still very, very high. This merits watching very closely. Right now, we're currently sitting at about 38 times earnings, when you'll see the average is normally about 16. So we're pretty high right now. We really are. We can look at other things like price to book value, okay? Price to earnings, which we just looked at, the Buffett indicator, which we'll look at in a second. All of these are showing a market that's pretty frothy right now, that's pretty expensive. I don't know that we're overvalued necessarily. We're going to talk more about that in a second, but you're seeing an expensive market. It's no surprise that the market's hitting all new highs just about every day. This is one that we use called the quote-unquote Buffett indicator. This is one of Warren Buffett's favorite charts. He looks at corporate stocks, the stock market, the value of the stock market. If you added the price, the market capitalization of all the publicly traded companies in the U.S., and you compare that to the size of the total U.S. economy, you're going to get this so-called Buffett indicator. Right now, the stock market is roughly twice the value of the entire U.S. gross domestic product, or what our economy produces in a year. So that's pretty high. That's actually significantly higher than we were tech bubble, late 90s, early 2000s. Pretty expensive. A favorite of mine is looking at margin debt. In other words, borrowed money versus the stock market. So your red line, you've seen this, I show this pretty much every year in the halftime reports. The red line is margin debt or borrowed money in the stock market. The blue line is the stock market. So you've seen significant growth in both, particularly since the COVID pandemic last year. So the red line, borrowed money, blue line, stock market, gray bars are recessions. When you see that red line begin to drop precipitously, borrowed money to drop precipitously, that's usually a pretty good indicator that you're going to see a drop in the stock market and you're probably about to have a recession. So good leading indicator, again, shows a pretty expensive market. However, earnings or corporate profits have been absolutely spectacular. Just like we measure the U.S. economy by GDP, by gross domestic product, that's the bottom line report card on the economy, we can measure earnings per share or EPS. That's kind of the bottom line report card on a publicly traded company, on a stock. How many earnings or what are the earnings, what are the profits, how much profit is that company making? So you've seen these estimates, these expectations continue to grow, and then you've seen the actual results even blow those increased estimates out of the water. Okay, so growing earnings, which we are seeing, we're seeing them very much so growing a lot. Growing earnings may help the market maintain its high valuations in the near term. So first quarter 2021 earnings were up over 50% from first quarter 2020. So earnings, corporate profits grew 50% for the first quarter. It's no surprise, year over year, so it shouldn't be much of a surprise that the stock market was up over 50%. That's pretty amazing. Now, second quarter, which we just finished, and third quarter earnings last year during the pandemic were abysmal. It won't be hard this year to show improvement over last year's earnings. So if your kid makes an D- or an F on their report card, think about it. It's not going to be hard for them to show improvement. So second quarter and third quarter earnings this year, we expect to be quite strong. that again could help drive the stock market. This is a busy chart, but I'll try to translate it to English for you, okay? So just like there are departments in a grocery store, if I go into a grocery store, I'm going to see a produce department, a bakery, a deli, a meat market. I'm going to see groceries. I'm going to see a pharmacy. I'm going to see different departments. There are different departments, if you will, in the stock market. Each one of these little colored boxes represents a different department in the market. What this is showing, this is ranking performance top to bottom of those different departments or categories or sectors in the market from 2003 through last year. The interesting thing you'll see is that no one category, no one department, no one colored box wins every single year. Okay? The mistake that a lot of investors make is they want to put all their money this year in whatever category or sector did the best last year. That's often a mistake, and that's kind of what this chart shows you. It's the equivalent of betting on a horse race and betting on the horse that won the last race. Chances are that horse can be tired, and we need to watch that. So that's the importance of diversification. This shows the S&P index is up in spite of what we call black swans, okay? So the black swans are different events that happen. Last year, COVID was the quintessential poster child for black swans. One of those things that seemingly came out of nowhere that affected everything, the economy, our daily lives, the stock market. And you see that no matter what is happening or going on, you see all these different headlines, all these different black swan events, but you'll notice the overall trend in the market has been up. So we're in the first year of the Biden administration, okay? These are stock market returns in the first year of a 4-year presidential term, okay? If that makes sense. So you'll see the red bars are when a Republican's in office, their first 4-year term. Blue bars are when a Democrat is in the office, their first 4-year term, first year of a 4-year term. So you'll see that overwhelmingly stock market returns during the first year of a presidential term tend to be pretty high. Going back to 2007, and we showed you that chart with the litany of disaster, all the headlines, all the black swans, okay? You saw that, and you saw that overall the stock market trended up. These are cumulative returns from 2007, prior to the financial crisis of 2008, to now. Okay, and we're looking at the blue line, which is stocks, the orange line, which is gold, the lighter colored orange line, which is treasury bonds, CPI, inflation, home prices, cash, and even oil. And you see average returns over that time. Lo and behold, even though all these things have happened, stocks won. Stocks outperformed everything else, including gold, including real estate, during that time. One of the things we're going to be watching very closely going forward is tax policy. So we're watching the Fed policy. Obviously, you have to do that, but we're also watching tax policy. So the Biden administration has proposed several different changes to our current tax policy in that taxes, corporate tax rates, and income tax rates are probably going up. So this kind of shows you where we are currently as far as top income tax rate for individuals, corporate tax rate, long-term capital gain tax rates, and so on. Then you'll see to the next column over to the right what President Biden is proposing. So these bear watching. Capital gains, I think that bears watching significantly, and I also think that corporate tax rate bears watching significantly. So if those, and these are proposed, again, this still has to make its way through Congress, particularly in the Senate, but these things bear close watching to see how that affects the economy and or corporate profits. We talk a lot rightfully so, about the Fed. So what happens after the first interest rate hike? Historically, when the Fed starts raising interest rates, they've told us they're not going to do that till 2023, but when the Fed does eventually start to raise interest rates, how will stocks do? How have they done historically? Well, if you'll look, you see these dates of the first rate hike, the most recent being the top line, December 16th of 2015, after 3 months, after 6 months, after 1 year. On average, the stock market is up 10.2% after 1 year following the very first interest rate hike. Positively, the market's positive about 85.7% of the time after the first rate hike, okay? It's when you get into the second and third and fourth rate hike that the market can start to act a little erratic, and that's something we are definitely watching. So let's talk about what could go right. Well, earnings in the economy could continue to grow. We do believe that earnings will slow down. They're still going to be growing, and they're still going to be doing significantly better year over year than they did last year, but earnings in the economy could continue to grow. We think that'll moderate, but we do think that'll continue. No dramatic increases in COVID cases, particularly this new Delta variant that we're seeing. Inflation could truly be a temporary or transitory problem, particularly as it relates to supply chain issues. The Fed could hold off tapering its asset purchases, that quantitative easing, and or raising interest rates. All of those we believe would be very good for the economy and for the markets. On the other hand, what could go wrong? Well, inflation could continue to rise and be a persistent, ongoing problem, forcing the Fed's hand, forcing them to act sooner rather than later, sooner than it really wants to, on tapering assets and raising interest rates. The Fed could get it wrong. The Fed could taper its asset purchases, stop the quantitative easing money printing a little too quickly, or raise interest rates a little too quickly. That could affect earnings. That could affect the economy and the stock market. We could have another outbreak or relapse of COVID cases or COVID variants. This one's real. Higher taxes could affect corporate earnings and slow the economy down. And last, we could have another black swan event. COVID, again, was the ultimate black swan event that we saw last year. Those all can come out of nowhere and affect the economy and affect markets. Here's what we think, okay? Inflation will moderate. It'll slow down, but it won't completely go away, I believe, because of the labor costs and the increase in labor costs as these jobs get filled. We believe that the Fed does hold off on its interest rate increases until at least 2023. We'll see about the asset purchases and all of the quantitative easing, but I think rates will hold here until at least 2023. We think the economy recovers to pre-COVID levels, which we're getting there very rapidly, and then grows at a much more moderate or normal pace, okay? And I think this could be true of corporate earnings as well. Lastly, we think the S&P 500, the stock market, will finish the year at about 4,500 points. Again, this is the S&P, not the Dow, but about 4,500 points to end this year. We're expecting somewhere around 5,100 points at the end of next year. So that kind of gives you an indicator of where we think the market is heading. Again, Lance Browning, Income Solutions, Wealth Management in Tyler. Thank you for tuning in. Thank you for joining us. As always, don't hesitate to reach out if you need anything. Hope you have a great rest of 2021. Enjoy your summer. God bless.